I want you to think about your mortgage in a way most people are never taught to think about it. Most people think debt is simply good or bad. They think having a mortgage is a burden and paying it off as fast as possible is automatically responsible. That belief is emotionally satisfying, but it is not always economically correct. Debt is not just a number you owe. Debt is a contract written in a currency. And when the value of that currency changes, the real weight of the debt changes with it. That is the part most people miss. A 30-year fixed-rate mortgage is not only a monthly payment, it is a long-term promise to repay future dollars at a fixed rate, even if those future dollars become weaker. In an environment where the government has very large debts, where inflation keeps returning, where interest rates are pressured lower than the true cost of living, and where policymakers need to reduce the real burden of debt without saying that out loud. A fixed-rate mortgage can become very different from what people were told it was. It can become one of the few debts that inflation works to shrink for you. This is not because anyone in Washington is trying to help you personally. Large systems do not operate that way. They are not kind, and they are not cruel. They are machines. They respond to pressures. The United States government has roughly $39 trillion of debt. The exact figure moves constantly, but the direction is clear. The debt is large. The interest cost is large. The refinancing burden is large. The political ability to fix it honestly is small. That combination creates a predictable pressure. The system wants the debt to become smaller in real terms. It can happen through default, which is destabilizing. It can happen through austerity, which is politically difficult. It can happen through taxation, which is limited by incentives and resistance. It can happen through extraordinary growth, which would be the best outcome but cannot be assumed. Or it can happen quietly through inflation and low real interest rates. That last path is called financial repression. The phrase sounds academic, but the mechanism is very simple. If inflation runs at 4% and savers earn 2%, the saver loses purchasing power while the borrower repays debt with cheaper dollars. The account balance may rise, but the real value falls. The lender receives dollars, but the dollars buy less than they did when the loan was made. This is how large debt burdens can be reduced without a dramatic default. You do not cancel the debt by deleting it. You cancel part of it by weakening the unit in which it is measured. I think of it like a battery. A dollar has purchasing power inside it, just like a battery has charge. The number printed on the dollar does not change. The dollar still says $1. But if inflation drains the charge inside that dollar, it buys less. The outside looks the same. The inside is weaker. That is what inflation does to money. And if a debt is written in that money, inflation drains the real power of the debt too. If the government owes $39 trillion and future dollars are weaker than today's dollars, the real burden of that debt declines. Bondholders still receive the dollars they were promised. Savers still see numbers on statements. But the purchasing power transferred back to them is smaller. This is not a conspiracy. It is debt cycle mechanics. The same logic applies to a fixed-rate mortgage. If you borrowed $300,000 at a fixed rate years ago and your payment is locked for 30 years, the bank cannot suddenly ask you to pay more because the dollar weakened. Your payment is fixed in nominal dollars, but your income, rents, wages, business revenue, and asset values may rise over time with inflation. That gap matters. Your payment stays the same. The world around the payment reprices. The result is that the mortgage becomes lighter in real terms. You do not feel it in the first month. You may not notice it in the first year. But over 10 or 20 years, the effect can be enormous. That is why the question is not, do I hate debt? The question is, what kind of debt do I have? At what rate, against what asset, under what inflation environment? And with what cash flow? A bad debt finances consumption at a high interest rate. A good debt can finance a real asset at a fixed low rate in a currency that weakens over time. Those two things should not be treated the same. Many people were taught to pay off all debt as fast as possible because debt feels like a moral burden. I understand that. There is psychological value in being debt-free. For some people, that peace is worth a great deal. But there is a difference between psychological comfort and economic optimization. If you have a low fixed, Rate mortgage and inflation runs above that rate over time. The real cost of that mortgage may be negative. You are paying the bank back in dollars that are losing purchasing power faster than the interest rate you owe. In that situation, accelerating the mortgage payoff may not be wise. It may feel responsible, but economically it can mean giving the bank strong dollars today instead of letting future weaker dollars do the job. That is the central idea. Now look at the government's position. The federal government has a large amount of debt that must constantly be refinanced. A huge portion of the debt rolls over again and again. If interest rates stay high for a long time, the interest expense grows and crowds out other spending. That creates pressure on the Treasury, pressure on Congress, pressure on the Federal Reserve, and pressure on the political system. Policymakers can say they are independent. They can say they are data dependent. They can say they are committed to price stability. Those things can be true in a narrow sense. But systems under debt pressure have incentives. The incentive is to keep nominal rates low enough relative to inflation that the real debt burden declines. This happened before, after World War II. The United States had a debt burden that looked frightening. Debt was more than 100% of GDP. Many people believed the country was trapped, but over the following decades, the ratio fell dramatically. It did not fall only because the government wrote a giant check and paid down the debt honestly. It fell because growth, inflation, capped rates, regulated savings returns, and financial repression worked together. Bondholders and savers were paid in nominal dollars, but those dollars lost purchasing power. The debt became easier to carry because the currency became less powerful over time. That is the historical playbook. The names change, the institutions change, the language changes, but the underlying mechanism remains. When the debt is too large to resolve directly, the system looks for ways to reduce it indirectly. The loser in that system is often the saver who holds cash at a low rate. This is the person who believes safety means a large balance in a bank account. This is the person who has $100,000 sitting in a traditional savings account, earning almost nothing, while the cost of food, insurance, medical care, energy, and housing rises around them. They may feel safe because the nominal number is still there, but the real value is being drained. That is the harsh truth. The bank statement does not show purchasing power loss clearly. It shows dollars. And dollars can hide damage because the units remain the same while the value inside the units changes. If inflation is 3%, 4%, 5%, or more, and your bank, you are not standing still. You are moving backward. You are not losing dollars. You are losing command over goods and services. That is the loss that matters. In a financial repression environment, the system requires a losing side. Debt cannot become lighter for borrowers unless lenders and savers receive weaker purchasing power in return. The government benefits because its debt becomes easier to manage fixed. Rate borrowers can benefit because their payments become lighter. Asset owners can benefit because real and productive assets often rise in nominal terms. But cash holders get harvested quietly. That is why the first step is to stop thinking in account balances and start thinking in real purchasing power. If you have a low fixed rate mortgage, pull the amortization schedule and look at what you are actually committed to pay. Look at the rate. Look at the fixed payment. Then ask what happens if your income, rents, business revenue, or asset prices rise over time while the payment does not. That is the trade. The payment remains fixed. The currency weakens. The real burden declines. If your mortgage rate is below the long-term inflation you expect, extra principal payments may not be the best use of capital. They may reduce debt, but they also remove liquidity and return valuable low-rate debt to the bank early. Again, this is not a universal rule. If your mortgage is high rate, variable rate, unaffordable, or attached to an asset you cannot support, the analysis changes. If the debt causes emotional stress that damages your life, the psychological return of paying it down may matter. If you have no other productive use for capital, paying down debt may still make sense. But do not use one simple rule for every environment. Principles must fit conditions. The condition today is that governments have strong incentives to reduce real debt burdens through inflation and low real rates. That makes low fixed rate debt structurally valuable in a way many people do not understand. The second step is to examine your savings rate against inflation. This is simple, but most people never do it. They look at what the bank pays them and think in nominal terms. They say, I earned 4%, or I earned 1%, or I earned almost nothing. But the real question is, what did inflation do at the same time? If you earn 1% and inflation is 4%, your real return is negative. If you earn 4% and inflation is 6%, your real return is negative. If your money sits at a large bank earning almost nothing while the bank lends those funds out at much higher rates, you are providing the bank cheap funding while absorbing the purchasing power loss. That may be convenient, but it is not intelligent if the balance is large and unnecessary. Cash has a role. Emergency reserves matter. Liquidity matters. You should not invest every dollar and leave yourself fragile. But excess cash that earns less than inflation is not safety. It is slow erosion. Move idle cash into instruments that at least compete with inflation when possible. That might mean higher yielding savings accounts, treasury bills, money market funds, or other liquid vehicles appropriate to the person's situation. The details depend on taxes, liquidity needs, risk, and access. But the principle is universal. Do not let lazy cash sit in a place where it is being silently drained. The third step is to think about home equity properly. Many people have large equity in a house and very low rate fixed debt against it. They feel rich because the house value has risen. But that equity is illiquid. It is stored purchasing power trapped inside the property unless it can be accessed or used intelligently. This does not mean you should rush out and borrow recklessly against your house. That would be the wrong lesson. Debt can be dangerous. Leverage magnifies mistakes. A home equity line, cash, out refinance, or reverse mortgage can create serious risks if used for consumption, speculation, or poorly timed investments. Anyone considering those tools must understand the terms: rate structure, repayment obligations, tax implications, and personal risk. But the broader point is important. If you own a real asset financed with long-term fixed rate debt, inflation may be transferring value to you over time. The question becomes how to preserve that advantage, not how to accidentally destroy it. If you refinance a very low fixed rate mortgage into a much higher rate just to extract cash, you may give up a valuable position. If you accelerate payoff aggressively, you may give back a low-rate liability that inflation was already shrinking. If you leave all your liquidity in low-yield cash while paying down cheap debt, you may be moving capital from flexible to illiquid at exactly the wrong time. The right answer is not always borrow more. The right answer is understand what you own. A low fixed rate mortgage against a real asset can be a very powerful position when inflation is being used to reduce debt burdens across the system. You must not treat that position casually. Now let us look at who loses. The saver loses when savings yields are held below inflation. The long-duration bondholder loses when fixed payments fail to keep up with the weakening currency. The person on a fixed income loses when their income does not adjust as fast as prices. The person who refuses all productive assets because they fear volatility loses slowly through inflation. The person who pays down cheap fixed debt while holding too little exposure to assets may lose optionality. And the person who follows old rules from a different monetary environment may make decisions that feel responsible but produce poor real outcomes. That last point matters. Rules that worked in one environment can be harmful in another. Paying off debt aggressively made more sense when interest rates were high. Savings accounts paid meaningful real returns. Inflation was stable, and debt did not function as an inflation hedge. But when you hold a 3% fixed mortgage in a world where inflation and wages may rise faster over time, the debt has a different character. The rate is fixed, the payment is fixed, the dollar is not fixed in value. That is the asymmetry. The bank gave you strong dollars when the loan was made. You repay with future dollars whose purchasing power may be lower. The longer the duration and the lower the fixed rate, the more powerful this mechanism can become. This is why institutions care deeply about duration, inflation, and real rates. Ordinary people are often taught to care only about the payment. That is not enough. You need to understand the real value of the payment over time. If inflation compounds, a payment that feels heavy today can feel much lighter 10 or 20 years from now. The house may be worth more in nominal terms, That is how inflation quietly transfers value from the lender to the fixed-rate borrower. But again, this works only if the borrower survives. If you lose income, over-leverage, speculate with extracted equity, or take on variable rate debt you cannot manage, inflation will not save you. The same environment that benefits fixed rate borrowers can destroy people with floating rate debt or insufficient cash flow. So the principle is not debt is good. The principle is that certain types of debt in certain environments can be assets. A low-rate fixed mortgage on an affordable property is very different from credit card debt. Adjustable rate debt, margin debt, or consumer loans. One can be a tool, the others can be traps. This is where thinking in systems matters. You must look at the asset, the debt, the cash flow, the rate, the duration, and the currency together. A house with a low fixed mortgage and rising rents can be a strong position. A house with an unaffordable payment, high maintenance, high taxes, and no liquidity can be fragile. A paid-off house gives peace and security. A low-rate mortgage with invested liquidity may give flexibility and higher expected real wealth. Both can be right for different people. What is wrong is making the decision blindly because someone gave you a simple rule. Now let us return to the broader debt cycle. When the government is over-indebted, it prefers financial conditions that reduce the real burden of debt. This does not mean inflation is allowed to run completely out of control. A currency collapse would create a different kind of crisis. The desired path is more subtle. Enough inflation to erode debt, enough rate control to keep interest costs manageable, enough asset price support to preserve confidence, enough public language about stability to keep people calm. That is the ideal repression path. It is not guaranteed to work smoothly. It can break. Inflation can run too hot. Markets can rebel. Bond yields can rise. Political constraints can change. The Fed can tighten again. Growth can slow. The dollar can weaken in disorderly ways. But the incentive remains. Large debt systems prefer gradual inflation over explicit default. That is why you must own assets and liabilities with that possibility in mind. Your mortgage is a liability in nominal terms, but in real terms it can behave like an asset if the rate is low and fixed and the currency is being weakened. Your savings account is an asset in nominal terms, but in real terms it can behave like a liability if it earns less than inflation. That inversion confuses people. The thing that feels bad can be good. The thing that feels safe can be dangerous. This is why principles are more important than emotions. Emotions say debt is scary and cash is safe. Systems thinking says it depends on the rate, the duration, the cash flow, the inflation rate, and the purpose. Let me be clear about the 3 practical moves in principle form. First, know your mortgage. Know the rate, the term, the remaining balance, the payment, the amortization schedule, and whether the rate is fixed. If the mortgage is low rate and fixed, understand that inflation may be working in your favor. Do not accelerate payoff automatically without comparing that decision to the value of liquidity and alternative uses of capital. Second, know your cash. Know what every bank account pays. Know what inflation is doing. Know how much cash you truly need for emergencies and near-term obligations. Anything above that should have a deliberate purpose. Lazy cash is a silent donation to the system. Third, know your equity and liquidity options. Home equity is valuable, but it is not the same as liquid capital. Learn the tools before you need them. Understand home equity lines, refinancing trade-offs, reverse mortgages for older homeowners, and the risks of each. Do not use these tools casually, but do not remain ignorant of them either. Ignorance is expensive. The system is built to be understood by institutions and felt by households. Institutions talk about real rates, duration, repression, refinancing walls, and balance sheets. Households talk about monthly payments, savings accounts, and whether they feel safe. That gap is where wealth transfers happen. If you want to be on the right side of the transfer, you have to learn the institutional language without losing practical common sense. What matters is not whether a banker calls you and explains it. They probably will not. Their incentive is not to teach you how your low fixed-rate mortgage benefits from inflation. Their incentive is to originate products, gather deposits, manage risk, and protect the institution. No one is required to optimize your balance sheet for you. That is your responsibility. A bank may happily accept extra principal payments on a 3% mortgage because that removes a low-yielding asset from their books and gives them capital back today. You may feel responsible sending that payment. But from a system perspective, you may have given up a favorable liability. This does not mean the bank is evil. It means incentives differ. You must understand your side of the trade. Now, I want to deal with the emotional argument. Some people hate debt so much that they would rather be mathematically suboptimal and psychologically free. That is legitimate. Life is not a spreadsheet. If a mortgage causes deep stress, if the payment creates fear, if paying it off gives a person peace that allows them to live better, that matters. But do not confuse personal emotional preference with universal financial truth. For someone else, preserving a low fixed rate mortgage, keeping liquidity, investing in productive assets, and allowing inflation to reduce the real debt burden may be the more rational path. The right answer depends on the whole system. That is a very Dalio way to think. Do not ask what is good or bad in isolation. Ask how the pieces interact. Debt interacts with inflation. Inflation interacts with wages and asset values. Rates interact with mortgage value. Liquidity interacts with optionality. Home equity interacts with leverage. Savings rates interact with purchasing power. The Fed interacts with the Treasury's debt burden. The Treasury's debt burden interacts with political reality. Political reality interacts with inflation tolerance. It is all one machine. The household balance sheet is connected to the national balance sheet more than most people realize. If the government needs inflation to reduce its debt, every household with fixed-rate debt and real assets may receive a side benefit. Every household holding idle cash may pay part of the cost. Every retiree living on fixed income may feel the squeeze. Every investor who owns productive assets may have a different experience from the person who owns only nominal claims. That is why the same policy can create winners and losers without ever naming them. The winners are not chosen personally. They are positioned structurally. That is the key. You do not need to be invited into the room. You need to understand the incentives before the consequences arrive. Now, should you rush into hard assets, real estate, or leverage because of this? No, rushing is how people turn a good principle into a bad outcome. If you buy the wrong property at the wrong price with the wrong debt and bad cash flow, inflation will not make you brilliant. If you borrow against your house to speculate, you may turn a strong position into a fragile one. If you chase high-yield products without understanding risk, you may lose more than inflation would have taken. The point is not to become aggressive. The point is to become accurate. You want assets and liabilities arranged so that the likely policy environment helps you rather than hurts you. That means owning things that can adjust with inflation, preserving low fixed-rate debt when appropriate, avoiding excessive idle cash, and not over-concentrating in any single idea. It also means keeping enough liquidity to survive shocks, because cycles do not move in straight lines. Inflation may run hot, then cool. Rates may fall, then rise again. Housing may appreciate, then stagnate. The Fed may cut, then pause. Markets may price one story, then reverse. A good structure must survive multiple paths. If your plan only works in the exact scenario you imagined, it is not a plan. It is a bet. Now let us think about the older saver with a large sum in a low-yield savings account. That person may have done everything society told them to do. Work hard, save money, avoid debt, trust the bank, do not take risks, be responsible. Those values are honorable. But the monetary environment can punish honorable behavior if the strategy is outdated. That is the tragedy. The person is not foolish. The rulebook changed around them. In a world of high real interest rates, saving cash could be rewarded. In a world of financial repression, cash can be penalized. The same behavior creates different outcomes under different conditions. That is why education matters. Not hype, not fear, education. If a saver understands that cash is losing purchasing power, they can still keep emergency funds but move excess cash into better, yielding safe instruments. If they understand inflation, they can evaluate income-producing assets. If they understand fixed-rate debt, they can make better decisions about whether to pay off a mortgage early. Knowledge does not eliminate risk. It changes which risks you are taking consciously. The worst risk is the one you do not know you are taking. Many savers think they are avoiding risk by holding cash, but they are taking purchasing power risk. Many homeowners think they are reducing risk by paying extra on a cheap fixed mortgage, but they may be taking liquidity risk and giving up an inflation advantage. Many retirees think CDs are safe, but if the yield is below inflation after tax, the real return may be negative. The surface says safe, the structure says otherwise. That is why I keep returning to reality rather than appearances. A low fixed-rate mortgage looks like debt. Structurally, it may be a hedge against inflation. A savings account looks like an asset. Structurally, it may be a melting ice cube if the yield is too low. A house looks illiquid. Structurally, it may be a real asset financed with fixed-rate debt. A paid-off house looks secure. Structurally, it may concentrate too much wealth in an illiquid asset if the owner has too little cash. Each piece must be examined in relation to the whole. That is the principle. The coming years are likely to be confusing because the language will not match the mechanics. Officials will talk about stability while purchasing power shifts. Banks will talk about safety while paying low rates. Commentators will argue about personalities while the debt cycle drives policy. Savers will feel responsible while losing ground. Borrowers with fixed-rate debt may benefit without understanding why. Do not let language replace analysis. Ask what is happening to real value. Ask who receives weakened dollars and who repays with weakened dollars. Ask who owns assets that can reprice. Ask who holds claims that cannot. Ask who has fixed liabilities and who has floating liabilities. Ask who has liquidity and who has trapped equity. Ask who understands the machine and who simply feels the machine. This is how you move from being acted upon to acting with awareness. Let me bring the argument into one simple framework. If you have low fixed-rate debt, inflation may reduce its real weight. If you have cash earning less than inflation, inflation reduces your real wealth. If you own real or productive assets, inflation may lift their nominal value, though not always smoothly. If you own long fixed income claims with low yields, inflation may damage your real return. If you over-leverage, inflation will not save you from bad cash flow. If you keep no liquidity, a good long-term position can still fail in a short-term shock. If you diversify intelligently, you can survive more scenarios. If you follow rules from the wrong era, you can lose while believing you are being prudent. That is the essence. The government's debt problem is not separate from your mortgage decision. It is connected through the currency. The same dollar that measures federal debt measures your mortgage. The same inflation that reduces the real burden of government debt can reduce the real burden of your fixed-rate mortgage. The same repression that helps the debtor hurts the saver. You are somewhere in that system. The important question is where. Are you primarily a saver earning below inflation? Are you a fixed-rate borrower with a real asset? Are you a variable rate borrower exposed to rising payments? Are you an asset owner with pricing power? Are you a retiree whose income lags costs? Are you liquid enough to survive volatility? Are you concentrated in a way that could break you? These are the questions that matter more than whether one speech, one nomination, or one viral clip is exactly right. The macro story may be noisy. The balance sheet reality is concrete. Look at your balance sheet. That is where truth becomes personal. Do not wait for someone else to tell you what your mortgage is worth. Do not wait for your bank to explain the value of your low fixed rate. Do not wait for a politician to admit that inflation reduces debt burdens. Do not wait for mainstream media to describe financial repression in plain language. By the time a mechanism becomes obvious to everyone, the advantage has usually already shifted. You do not need to predict every policy move. You need to understand what incentives the system has and make sure you are not standing on the wrong side of them. The system has an incentive to reduce the real value of debt. That means fixed rate borrowers can benefit. The system has an incentive to keep savers calm while real returns are low. That means cash holders can lose quietly. The system has an incentive to support asset prices because asset prices support confidence. That means productive and scarce assets matter. The system has an incentive to avoid open default. That means dilution is more likely than destruction. Once you understand these incentives, the path becomes clearer. Do not panic. Do not chase. Do not blindly pay off cheap fixed debt. Do not let large cash balances rot at low rates. Do not borrow recklessly. Do not confuse home equity with spendable wealth. Do not ignore inflation because your nominal balances look stable. Do not let old rules make new mistakes. Think in real terms, think in systems, think in probabilities. The people who survive debt cycles are not the ones who get every headline right. They are the ones who understand the direction of pressure and structure their lives so that pressure works for them, or at least does not crush them. That is the goal. Not to be clever, not to be dramatic, not to win an argument online. The goal is to protect purchasing power, preserve optionality, and use the structure of the system instead of being used by it. Your mortgage may be a burden, or it may be a quietly valuable contract. Your cash may be safety, or it may be fuel for someone else's balance sheet. Your house may be a home, or it may be an inflation-linked asset financed with fixed-rate debt. The difference is understanding. Once you understand, you can choose. And in a world where the debt machine is already moving, choosing consciously is the first form of protection.